Now we leave Europe. We know everything about it. We know we can forget about Marie Le Pen and all the other stuff. Now we go to the Americas, starting with North America. That's where we are. And I would like to introduce our speaker. Some of you know him already. We know him very well. Peter Hall. He's the Vice President and Chief Economist at Export Development Canada. And the title of today's presentation is North America Outlook. Peter, the floor is yours.
Thank you, Kirsten. Well, that's probably the most boring title that I have ever come up with, so I apologize to you for that, but I trust that the presentation is not going to be likewise boring. I think I probably have the most fascinating area in the world to cover over the next little while, and of course my challenge is going to be cramming everything that needs to be said about the United States of America and Canada as that sort of appendage to the US and what our outlook is going forward. So, and if I got tweeted on that right now, I probably don't have a job when I get home. So just be careful with me, okay? So thank you very much again for the invitation to be here today. So I'm going to start off in a non-traditional way. I would typically start off with the United States and then sort of talk about the effects on Canada. And I'm going to do that in the reverse order this time around for reasons that I hope will become very apparent. And so you can start answering the question, the first question that's on the poll there, so that we can have the results by the time we're ready to have a look at that. I think it's probably been loaded up at this point. So where am I going to start off with? Well, let's start about the things that Canada's really struggling with at the moment. This is the personal debt ratio inside of Canada. And what should stand out to you right away is that we are currently at a ratio that is very similar to where the United States was at just before the recession. And that's not a happy marker here. This is a rate of indebtedness at the consumer level that, you know, if you get a 1% change, let's say, in interest rates over the next while, and, you know, asking for 100 basis points is a lot at this point in time, but over about a 2-year period of time, maybe a little bit longer, you would see that eating into personal disposable income to the tune of about 1.67 percentage points. And given that we're struggling to get 2 to 2.5% growth, that's the kind of duress that we're talking about in Canada. So the carrying costs of the debts, both mortgage and consumer credit inside of Canada, are very vulnerable to an increase in interest rates. Now, many are typically used to the interest rate cycles in Canada and the United States being very synchronized. And so if that's the case, then wire in expectations on the Fed over the next little while to the Canadian situation, and you're talking about 60% of the Canadian economy that is very compromised at this point in time. So that is sort of risk number one. You might say, that's really not the same story that is being told elsewhere at the moment. We're talking about gathering momentum in most places. And this is where we sort of have to stop and say, are we going to depend on alternative data, or are we going to depend on standard markers out there? Well, I'm not going to get into that debate at the moment, but when I look at the standard markers of an economy, I believe that what we're taking our eyes off is, how did we actually get to the point that we're at the moment? And that's instructive not just to the Canadian economic outlook here, but to the US economic outlook, and for that matter, the outlook for the rest of the world. And I'm going to run the risk of being at odds with fellow speakers here, because I'm going to take Richard to task on his assertion that, you know, we're on the verge, maybe I'm wrong in attributing this assertion to him, but that we're on the verge of some kind of correction if you look at the standard length of cycles. Let's talk about the Canadian situation first. We've got a very odd Canadian economy at the moment. When the Great Recession happened, we lost 25% of our trade, just like that. And we're a trading economy. You add exports and imports together, and that adds up to 60% of GDP. That's a relatively high trade intensity for any economy. We're a trading economy. And so when you lose 25% of that activity, that's usually carnage for the rest of the economy. It usually brings everything down. You have a very deep correction. What didn't happen in Canada was that the domestic sector collapsed when the trade sector collapsed back in the Great Recession. We actually had a domestic economy. We have to understand where Canada came from. We had a very protracted recovery from the 1990-91 recession because we had a very big fiscal contraction over that period of time. We had a jobless recovery. We had a lot of the things that we've got in the world economy right now. We had it one cycle ahead of time. And so when we got to the point of the Great Recession, our domestic economy was just catching up. So when stimulus came to the Canadian economy, it was actually very effective. Our housing market didn't correct anywhere close to where it did in the United States. And while the United States languished for a while, Canada rebounded to regular rates of growth. Everybody was saying, well, what's Canada's magic solution? Canada's magic solution was fiscal duress a cycle ahead of time. And so, we paid for it ahead of time, if you like. And so we were reaping the benefits of that. Stimulate the economy, you've actually got a domestic economy when trade collapses. Okay, but we overdid it. And now we've got this situation here, where we have an overextended consumer. Stimulus worked, but it caused us to overdo things. And now we're in a situation where 60% of our economy, that's what the consumer in Canada is relative to GDP, is actually quite compromised at this point in time. So this is a risk. This is a great risk for our economy going forward. The second thing is, you may have been reading about Canada's housing bubble. It's really the topic du jour in Canada at the moment because the statistics are coming out and they're eye-popping. You can see what's happening with housing starts at this particular point in time. Well, again, we need to put that in context because yes, we do have a housing bubble in Canada. The Bank of Canada actually said quite a bit before right now that the housing market in Canada was due for somewhere between a 10 and a 30% correction. That's over a year old, and we've just had a run-on of the same kinds of conditions, bubbles in the Toronto and Vancouver markets, but bubbles that have actually been exported to the rest of Canada by virtue of those bubbles in Vancouver and Toronto. So here we have a Canadian housing market. Let me just explain what this chart is doing to us here. The white line is housing starts in Canada. The gold line is what we need in terms of demographic requirements. So the Bank of Canada says we need roughly 185,000 housing starts every year. And you can see we've been trending above that for long enough that we have, and this is our calculation here, the bars in the background there, which say that we have an accumulation of excess housing inside of Canada. It's about 40% of a year's supply. So that implies that there is some downward movement and you can have quite a correction in the marketplace, but it's not a super bubble. So that's where Canada is on the domestic side. Sorry to start with the bad news, but that's sort of where we're at. We are vulnerable there. And it is partly because monetary and fiscal policy were very effective inside of the economy. So you might say, okay, well, that compensated for the hollowing out of trade back in the recession. What about now? I mean, what is going to happen on the trade side of things? Well, I'm not going to give you the answer to that because we want to see what our poll results are. I've brought the big dark cloud over the conference right now, so what do you think about Canada? We've got to get that up to about 90 or so before we can take these numbers to the bank. We should sort of have that Jeopardy music going in the background here. But, okay, so steady as she goes. All right, so what you're effectively saying is, given the vulnerabilities that are here, trade is going to bail us out. Isn't that right? Everybody agree? That's not a polling question, by the way. But do you think trade is going to bail us out? Some say yes. I see some heads going like this. I don't know what the veracity of that kind of poll is. But what do we say then about trade in the Canadian economy? Well, in the last few years, it hasn't really gone anywhere. We had a nice rebound in trade that was synchronized with the rebound that began in the United States economy that triggered off the beginnings of the withdrawal of quantitative easing from the economy, which is probably the best gauge that it really was the moment when the United States started to pick up. So somewhere around mid-2014 is when we see this happening, according to the chart here. But this is Canadian merchandise trade, and the question is this the trend line that we're on here, or is the recent trend what it is that we are on? Which one do we actually believe inside of the economy? Well, that's not something that actually gets determined inside of the Canadian economy. We've got to open things up and ask a much bigger question at this point. What are the external drivers that are going to lead to this? And what are the conditions inside of Canada, and how are they actually setting the stage for the neutralization of this risk that we have on the domestic side? And most people in the room seem to feel that that's what's going to happen. Well, we have this currency thing here, and I've got to ask this question here in New York City, okay? So go for it, folks. I need to know the answer to this. Ooh, some volatility there. Do we manipulate our currency in Canada? That's what we're charged with. Lots of people think we do. Now that's at the official level. There's a whole lot more brain power inside of this room, I'm sure. Did I bias the results? We do not. We do not manipulate our currency. Why is that the case? I'm going to move on to, you're not going to allow me to move on to the next slide. I guess the poll's not finished yet. Okay. What are the drivers of the Canadian currency? Do we really have control over what it is that's going on? Well, we are very much driven by oil and gas prices. If you're into rules of thumb, generally when West Texas Intermediate crude moves by $10, the Canadian dollar moves about 3 cents in that direction. Now, don't day trade based on that and nail me for your poor results, because it takes a little while for that to come about. But that's generally what goes on. We sell a whole lot more than oil and gas. We got a whole bunch of other commodities up in Canada, and they influence things as well. And when the non-energy index moves by 10%, you generally get a movement of the US dollar, or the Canadian dollar versus the US by 2 cents US. And again, you know, no day trading based on that. But that's generally the model-based rule of thumb that we've come up with this. Well, do we have control over these commodities? They're actually determined on the international marketplace. We're not significant enough producers to actually have that kind of effect. Third, you might say, okay, well, here's the scope that you have for manipulation, if you have it anywhere, interest rate spreads. And we basically use the 90-day Treasury bill rate, Canada versus the United States, and that gives us a pretty good characterization of things. And so when you open up a 100 basis point spread, generally that's good for about 3 cents on the Canadian dollar. You know, we go up 100 basis points versus the USD, we go up roughly 3 cents. That's the way it works. And so some would say, well, we're actually talking our currency down at the moment. And I don't know, I guess the way that we see monetary policy going, when you have a domestic economy that's as weak as I've characterized, you don't really have a good, strong case for a tightening of monetary policy. So we're not seeing the need to move that until mid-2018. Well, if that's currency manipulation, I'm sorry, but that's sort of the deck of cards that we were handed. And if you're going to carry out monetary policy in any kind of responsible fashion, then tightening rates at the moment can be highly punitive. Well, the last two are you know, a little bit more fudgy kind of notions. The trade-weighted US dollar. This is the US dollar doing something versus all currencies, which it actually is at the moment. If you look at the way that the Canadian dollar is moving at the moment, and has moved since mid-2014, well, those who are pointing the finger at Canada and saying, you're a currency manipulator, fail to realize that we've moved almost in sync with every other currency on the planet. If you look at the trade-weighted currency, we hardly deviate from that movement. So it's almost as if my first 3 categories don't really matter. It's sort of causing me trouble at the moment, but it's definitely an indicator that we're not a currency manipulator. And finally, this halo effect. Well, everybody thought Canada was the place to be when the Great Recession occurred. Lots of stuff was coming in. Now it's going out because we don't look as good as we did before. All of these things are arguing that we should have a currency that has weakened in the way that it did since mid-2014. Okay, given that then, does this give us some kind of leg up with respect to trade? Well, it certainly isn't hurting, but it hasn't, as you could see from my chart there, resulted in an absolute groundswell or a surge of Canadian exports. It's not doing what we're accused of trying to engineer here. And why is that? Principally because other currencies, most other currencies in the rest of the world, have moved in tandem with our own, and we don't have an advantage versus them. The only advantage that we have is the bilateral rate between ourselves and the United States. Okay, so what does that do? Well, it sort of still leaves the question open on Canadian international trade that only the US outlook and the outlook in the rest of the world can answer for us. Okay, so now's the right time, I think, to switch over to the US market and say, okay, well, that's probably the one that we're all really mostly interested in. What's it doing at the moment? Well, you look at this indicator here, and I'd have to say, well, Richard is probably right in saying that the US economy is pretty close to the point where you're going to have another recession. Because what is the unemployment rate in the United States actually telling us? Well, an official rate that dips significantly below 5% is at a point where real wages are going to start to tick up, and they have done that in the United States. So this is hitting a barrier that economists call the natural rate of employment, or the non-accelerating inflation rate of unemployment, NAIRU. It hits that point there, and all of a sudden, the pressures start to build in the economy. This is late cycle type stuff, and the economy is just about ready to correct because you're paying way too much for labor, you're not paying the marginal product, now you're fighting for a very small number of workers, you're bidding their wages up, inflation starts to take off, and the Fed comes in and says, we can't have this. They start increasing interest rates, and they calm the economy down, and if the economy, of course, has a bit of a bubble in it, then the economy really comes down and you have your next recession. Is that what's in store here? No. It's not. Can economists be definite? Yes, they can be definite. Why is that the case? Well, there are three groups that have actually been left out of this expansion. And they have created an effective unemployment rate that looks like this. And in case you think this is an economist up here that's into making up data to make my point, the Fed's calculation of this is actually wider than our own. So what is going on here? Well, the reason that you have a wedge in these unemployment rates is that a very unusual thing has happened with US labor force participation. Normally, when an unemployment rate comes down, the rate of participation heads up. And this time around, both have gone down in tandem. So you've got significant groups inside of the United States economy that this recovery has pushed to the side. Three of them that we can identify. One are a group of people who were close to retirement age, lost their jobs in the Great Recession, and got to retirement age before they were reabsorbed into the marketplace. They've retired with less income than they thought they were going to have, and they are mad. A second group is those who weren't quite as old, but they had been in the labor market for a while. They've lost their jobs, and for some reason they have not been re-engaged in the economy, and they're mad. And the third is those unlucky people that just happened to be born at a moment in history where they graduated from their secondary or post-secondary or university education in 2008. Lucky you. No job. And everybody beyond then had the same kind of difficulty. You graduate in that period of time, you're in a lot of trouble. And you're probably a barista somewhere trying to eke out an existence. Millennials have not been included in this recovery, and they're mad. So what happens when you get three significant groups of people that are mad? Because the economy is not working for them. You get polls that turn around and say, we do not believe in the system. We don't believe in globalization. We don't believe in institutions. We do not believe in those who are profiting from those, that 1% there who are now our sworn enemies. And you get electoral turnover. Yes, I'm betraying my biases. I believe that the economy is actually behind this swing around in what's going on globally and the questioning of what's going on with respect to institutions. Okay, so how do you remedy a situation like this? By the way, aging of the population means the trend in the participation rate is down, according to our estimation, but there's a huge gap between where it should be and where it actually is at this point in time. All right, so how do you characterize this picture? Well, when you can't find a job or a meaningful job, you stay at home with mom and dad. In record numbers, folks. This is amazing. You've got a very significant population base here, and inside of this ramp up here, you've got somewhere between 1.5 million and 3 million people who are less than engaged in the economy. And so you might look at that and say, well, it's still going up in 2016. This is really bad. Here comes the best chart in my entire deck. Am I good at setting the stage up for myself? Okay, this is not it, because you've seen this already. This is the unemployment rate. But here it comes, folks. Are you ready? Millennials are coming back into the market. Oh, man, a low unemployment rate is talking to the business community now. They realize that they can't just cherry pick people out there that are laden with skills and just waiting for somebody to come and pick them up. They're now, for the first time in 7 years, having to tap significantly into that marketplace where you have graduated but you don't have any experience, and you're going to need some training inside of your company. Implication, higher costs. But when you hit the wall, you've got to start engaging some of these people in the marketplace. Folks, the group 45 plus also are seeing this kind of uptick in their participation rate for the first time in 7 years. Now, why now? Why is this the point where the re-engagement actually happens? Well, my view of what is going on at the moment is we don't have the standard, whatever it is, 5 to 10 year growth cycle. But globalization and the advent of communication technology allowing for the spreading of business in a 24/7 means around the world almost seamlessly now has extended the growth cycle. For all intents and purposes, last time around, we had a 16-year growth cycle. That's very unusual. But it's very logical in a marketplace that has markets that can now reach or go towards their full potential in ways that they were never able to do before. When you have a significant number of emerging markets that can now do that, they have the capacity to extend the growth cycle, and I believe that's what we're going to see over the next while. Our problem is we haven't got our psychology around that particular development. Because when we grow for a certain amount of time, somebody like me comes along and says it's different this time, and we all lose it. We lower risk threshold, we create bubbles inside of the economy. When you get a 16-year cycle, you get a monster bubble on the end of that cycle. And that sets you up for a monster correction as well when you realize that you've got a bubble in the economy. But it doesn't mean anything's fundamentally wrong with the business cycle. What it does mean is it's going to take this time around about 7 years until you actually have a proper recovery. We have not had a proper recovery yet. Okay, how can I so confidently say that? By the way, here's a great chart here. Here's the intentions of millennials, country by country. It's not just a US phenomenon here, on home buying over the next short period of time. Here's what their ownership rates are and what their intentions are over the next little while. Could we have a housing boom in the economy? Well, let's have a look at the US economy. By the way, what do you say about confidence like that? Confidence that is now back to pre-recession levels for the first time in 7 years. That's another indication of where things are going. Okay, you've seen this chart already. You saw it for Canada. Totally different situation for the United States. Most agree that the United States needs somewhere around 1.4 million housing starts a year to satisfy demographic requirements. So that's the yellow line there. It's slightly increasing because you actually have a net increase in population in the United States, unlike most of the OECD. The white line is housing starts, and that perfectly illustrates, almost perfectly illustrates, the vast amount of swing that we have seen as a result of the boom and bust cycle, the 16-year cycle with that head of steam on the end of it there. A vast amount of overbuilding in the United States economy before the recession. A monster correction. How many industries do you know that went through a 75% reduction in output? You know, all of construction on the residential side in the United States went through that. That was cataclysmic in the US economy. It stayed there for 2.5 years. And so people are saying, well, it's more than double that now that must have recovered. Absolutely not. It hasn't even gotten back to demographic requirements yet. Why? This is where millennials are so important. They are first wave consumers. What does that mean? First wave consumers are people that are buying their first car, their first house, forming a family for the first time, maybe having kids for the first time, and all the expenditures that are associated with that. And if that's the case, and if they've been out of the marketplace in huge numbers for 7 years, we have not had a housing recovery in the United States. They come back into the marketplace, and all of a sudden, you've got all kinds of potential for growth. I am definitely not in the camp that says growth is finished, because the fundamentals are telling us here that there's still a lot of capacity to grow in the economy. How much? Well, in this simple indicator alone, 15% growth just to get back to demographic requirements, meaning that the deficit that is growing every month in US housing just gets closed at that point. You don't deal with the deficit, you just close it off. 15% growth. Now, if you don't care about the housing market, well, you should, because it's a leading indicator of economic activity, broadly speaking. It's not just housing that benefits from this, it's the entire macroeconomy. So do I believe that there's growth inside of this economy? Absolutely, I do. Is there capacity to actually facilitate this growth? Here's where we have a problem. This is one illustrator of quite a few industries in the US that are producing at capacity utilization rates that are far greater than they were in the previous boom, in the 2006 to 2007 period of time. The auto sector is at 115% of that rate of capacity utilization right now. I worry in the US economy that there isn't the capacity to create capacity to grow. That's a sort of different problem than most people are ready for. Can we have a $1.5 trillion infrastructure program at this point in time? Well, there's definitely the money to do it, but is there the capacity to do it at this point in time? I struggle with that at the moment. That's sort of a good problem to have, because it means that we could be on the cusp of a wave of investment inside of the US economy. Now you're thinking of this unbridled positive economist that can't be shot down. I'm just going back to not the alternative, but the fundamental data that I've been able to trust in over this entire turbulent period of time and say, that's what it's speaking to me at the moment. Okay, so into the middle of this comes all of this questioning that people have had, the ones that have been waiting for 7 years for something to happen. And we get announcements like, okay, we're going to tear up NAFTA. We're going to raise this border tariff. We're going to do that. And the questioning of globalization is really being debated on the front lines at the moment. Well, here's an analysis that we did of Canada to say, what's the duress on the Canadian economy? Well, it's pretty cataclysmic, because if you tear up NAFTA and the free trade agreement, we're in recession. If you impose a 10% border tax, and they're talking about a 20% one, well, that's just half of the impact, and you can see that that puts us in pretty deeply. We're a trading economy. These things really hurt us. But is that the right question to ask? If we're contemplating whether this is going to go through or not, does America really care? If it benefits America, does America really care? The right question to ask is, what is the cost to America of doing all of this? Okay, so what do you think? Final poll question here. How am I doing for time? 3 minutes. Ooh. You guys have been reading my stuff. Now, don't be biased what you see up there. Just say what you feel. No, this is quite extraordinary. So, I happen to agree. So we're all friends here today, right? Good stuff. Why do I agree? Well, when you look at the costs to America of what America is proposing to do, literally, there isn't the wiggle room. In fact, this could be highly damaging to an administration that has to go back to the polls for a midterm election in less than 2 years. You have to have wins in the column by that point in time, and I think it's absolutely fundamental to understand that. Okay, so what are some of the costs to America of anti-trade action? Number one, US trade with Mexico. By the administration's own calculations, 1.2 million direct jobs occur in the United States and depend on trade with Mexico. 1.2 million jobs, 360,000 by best estimates in Texas alone, which voted for President Trump. If you believe the Woodrow Wilson Institute, then they add the direct jobs together with the indirect jobs, and then also add the induced jobs onto that, and they come up with a 5 million figure. Those are substantial numbers in an administration that says it wants to create jobs and it actually wants to make America great again. What does Canada contribute? Well, in terms of direct jobs, by the US's own calculation, 1.7 million jobs, more than Mexico. We, Canadians, invest in the United States and have created in our factories and businesses in the United States 600,000 jobs by our calculation here. So employment is a big negative for some of these anti-trade measures. Consumers, I was down in Mexico in week 1 of the administration. I think, are you suicidal? You know, what on earth? You know, they were the butt of everything that was coming out in week 1 of the administration. I happened to be down there as a Canadian saying, he's not going to do it, he's not going to do it. I said it in 4 cities in 4 different speeches, and on Thursday, when I was done all of those speeches, he did it. He announces his 20% border tax. It's like, I can't believe it. I'm sitting in this beautiful Mexican restaurant, just about to go meet with the Ministry of Finance, and it's like I'm seeing 20% border tax. I cannot believe that this is happening. It's just, wah, you know, my credibility with the people that I've just spoken to is nothing. And what happened? Magically, beautifully, inside of an hour, Elliot Spicer comes out and says, well, this is just one of 5 options we're considering. And the president himself comes out and says, now we know we couldn't get away with this. Why? Because, you know, we're going to levy this 20% tax to pay for the wall. We know that it's really US consumers that are going to have to pay for this because the pass-through is going to be direct. Everybody's going to have to cough up for this. And they didn't vote for that. He didn't say that, but that's what he meant. Believe me. And so he U-turned on that. He U-turned on that right away. And my credibility went from being way down there to being whatever it was before and then some. Because it was exactly what logic would tell you would happen. Impose a 45% tax on China and everybody pays 10% more for everything in America. Did Americans sign up for that? Absolutely not. They would vote against that. That's not what they got into this for. Okay, so that's item number 2. Item number 3 is you can go ahead and impose, but you cannot create the investment in time to make up for the negatives of those first 2 things. It takes 2 to 3 to 5 years, actually, for that investment to actually make sense inside of the economy. Okay, there's more that we could say. Those are just America's actions. You got to remember that people don't take this standing up. You know, or sitting down, I should say. They react to it. They react against it. So that's just round 1 in this whole trade war. We're only talking about first round effects here. Okay, so does anybody want this? I don't think anybody really does want this. This is just a count of the job numbers. We've already gone over those. Okay, I don't have time to talk about this, so this is just really a characterization of how difficult it is to change the whole production system. If you want to bring all those jobs back to America, it's really difficult to do. You got to get consumers to buy in. America's a high-cost place to produce. They've got to pay more for it. You got to talk corporations into thinner bottom lines, and you got to talk shareholders into buying those stocks with thinner bottom lines. I don't think that's going to happen. Anyway, so where does that bring us to? It brings us to the end of the presentation. It brings us to a nice little picture here. 6 books that are stacked up there that are the books that are written on how it is that we got to the place that we are at the moment. Where is the place that we are at the moment? It's called the Great Hesitation. You need to listen carefully here because this is where the implications for your industry are most poignant. The Great Hesitation means that you have a strong economy, but at the same time as you have a strong economy, you have policy mayhem. And what do businesses do in a situation of policy mayhem? They pull back. You are at greater risk. Payments become a bit of a problem. What's my take on this? A lot of people are running away from very lucrative business. And they're running away for poor reasons because it ain't going to happen as much as everybody thinks it's going to. And we in this room, according to your poll results, all agree. It's going to be cameo moments, it's going to be this and that, but it's not going to be a destruction of globalization, because that would be suicide for the leader that puts it into place. So what's the gripper for all of us inside of all of this? While everybody else is hesitating, we can run into the middle of this. We can underwrite business, we can finance it, we can insure it, and run away with business that others are running away from. Thank you very much.